I now hand the conference over to Mr. Vishal Jain, Head Investor Relations. Thank you, and over to you, sir.
Good morning, everyone. I welcome you all to Q2FY22 and H1FY22 earnings call. Along with me, I have Mr. Amit Jain, Global CEO, Mr. Bahadur Dastoor, CFO, and Strategic Growth Advisors, our Investor Relation Advisors. We will start the call with an update on the solar power industry and operational highlights for the quarter and half year by Amit, followed by financial highlights by Bahadur, post which we will open the floor for Q&A. Thank you, and over to you, Amit.
Thanks, Vishal, and a warm welcome to all the participants on this call. I would like to give a quick update on the stake acquisition by Reliance Industries, solar power industry and other allied renewable businesses, and status on our business operation. In October 2021, Reliance New Energy Solar Limited, a wholly owned subsidiary of Reliance Industries Limited, executed definitive agreements with promoters of the company to acquire 40% stake in Sterling Wilson Solar Limited via a combination of primary investment, secondary purchase, and open offer. This deal would entail a cash inflow of rupees 1,100 crore into Sterling Wilson Solar Limited from preferential issue to Reliance New Energy Solar Limited, thereby strengthening the balance sheet and further improving our financial profile. Reliance is committed to making India a global leader in green energy based on latest and most cost-competitive technologies and development capabilities. Sterling Wilson Solar Limited, with its engineering talent, deep domain knowledge, global presence, and experience of executing some of the most complex projects globally, will become an important part of solar value chain of Reliance Group. Sterling Wilson Solar will immensely benefit from Reliance Group integrated new energy vision, which will further strengthen our position as a leading EPC and O&M player globally. This will provide us with great opportunity to further accelerate our revenue growth. Now I will give you an update on our waste to energy business. We signed our first waste to energy order in United Kingdom for approximately rupees 1,500 crores from a leading developer of energy assets in UK and Europe. The project is in collaboration with an associate company, and the project will be executed over a period of 3 years, which will provide consistent revenue stream year on year. The facility will process 23.2 ton of non-recyclable solid municipal waste per hour, diverting over 185,600 metric ton of waste each year and generate around 19.6 megawatt of energy. As per the contract, the company would receive 15% of the contract value as advance. From our waste to energy business, we largely plan to focus on Europe and UK, which constitute 40% of the global waste to energy market. We have recently opened a branch office in UK. The waste to energy market in Europe and UK is expected to grow by US $5.25 billion annually for coming 5 to 7 years. About 70 new plants are anticipated to come up every year until 2027. There is a robust bid pipeline for waste to energy business worth USD 685 million in the UK market. We expect gross margin for waste to energy business upward of 10% with negative working capital cycle. Now, as we informed during our last call that we have entered into battery energy and storage system. So battery energy and storage and energy storage system is expected to grow in next 4 years to $12 billion annually. UK and Europe will be the next big consolidated market, with UK, Germany, France, Italy, and Spain being top 5 countries. We have added team of battery experts, sales and execution team to capture this market opportunity, and have bid orders pipeline of 1.4 gigawatt hours across US, Australia, Europe, and Latin America. And now, the solar industry continue to face headwinds due to unprecedented increase in cost of modules, commodities, and freight cost over the last 1 year. It was earlier anticipated that situation would ease out and order finalization would pick up in H2 FY22. However, the prices continue to rise, making the project for IPPs unviable, and hence we anticipate that majority of order finalization will shift from current year to FY23. As a result, the short-term outlook continues to be challenging. The long-term outlook continues to remain robust due to global thrust on clean energy and significant solar capacity additions planned by IPPs globally. Our overall addressable market across the globe for solar EPC projects is expected to grow at 14 to 15% per annum. We have increased our focus on two large significant green energy markets, US and Europe. The USA market is expected to add at the rate of 25 gigawatt in 22, with 75% of the projects in utility scale. The recent US government policies have given a significant impetus to the growth of solar and energy storage, which gives us an exciting growth opportunity in one of the largest global markets. We have already completed 7 projects aggregating 38 megawatt in US. Currently, 2 large projects in USA aggregating 400 megawatt are in progress and expected to be completed by Q1FY23. This has resulted in Sterling Wilson being recognized as a strong EPC player in US market. In Europe, we have already opened our office in Spain last year, which will be our headquarters in Europe for European operations. 200 gigawatt of solar PV installation is expected by 2030 owing to shutdown of coal, gas and nuclear plants. We will be pursuing development activities in both US and Europe to secure more EPC business and increase market coverage in these markets. Further, the Indian market will continue to remain our focus. At recently held COP26 summit, Prime Minister Narendra Modi ji enhanced India's target for installed renewable energy capacity by 2030 to 500 gigawatt and also pledged to make renewable energy 50% of the country's energy mix by the end of the decade. So the Indian solar power market is brimmed for enormous growth over the next decade. Our unexecuted order book as of November 13, 2021 stands at rupees 6,730 crore, which is executable over the next 12 months. It is important to note that the module price risk is limited only to the pending partial supply for the 2 projects aggregating 422 megawatt amounting to rupees 765 crores. Now coming to our solar O&M business, our portfolio as of date is 8.4 gigawatt as of 30th September 2021, with third-party O&M constituting 44% of the portfolio. We are focusing on increasing international O&M portfolio through organic and inorganic route. Our enhanced value to customer through O&M differentiations like drone thermography, strong analytics and predictions, IV curve tracers, underground cable fault finder, etc. will help us to expand our O&M portfolio. With this, I will ask Mr. Bahadur, our CFO, to take you through the consolidated financial highlights. Thank you very much. Over to you, Bahadur.
Thank you, Amit, and good morning, friends. I will take you through the consolidated financials for the half year ended September 30, 2021. Revenue for H1 FY22 has been 2,633 crores as compared to 2,405 crores in H1 FY21. O&M constituted 4.3% of total revenue in H1 FY22. The region-wise revenue breakup is as follows. Australia contributed 57%, Americas contributed 27%, followed by India, which contributed 13%, and balanced 3% by MENA and Africa region. At a company level, the gross margin were impacted significantly in H1 FY22 on account of unprecedented increase in prices of modules, commodities and freight, and higher execution costs due to COVID. If we were to eliminate these unprecedented price increases, then the normalized gross margin for H1 would have been 3.5%. Further, the normalized margins for H1 continue to remain lower on account of carry forward impacts of items which had affected FY21. Recurring overheads for H1 FY22 increased by 8 crores to 171 crores. In H1, we have also accounted for accelerated mark-to-market loss of 58 crore on account of cancellation and rebooking of forward contracts on expiry relating to ongoing projects. This resulted in accelerated accounting of losses. The same has been flushed out from effective portion of cash flow hedge of the other comprehensive income, resulting in negligible impact on shareholder funds. The same would be reversed in the coming quarters and would be recorded as a gain. Now coming to the balance sheet. ICDs outstanding as at 14th August 2021 stood at 741 crore. I am happy to state that these ICDs have been fully repaid by Sterling and Wilson Private Limited and Sterling and Wilson International FZE, along with interest thereon during Q2FY22. With this, the entire outstanding loans of 2,563 crore as on the date of listing of the company's equity shares on the stock exchanges, along with all further interest accrued till date, stands repaid in full. However, gross debt have increased from 468 crore as at March 2021 to 674 crores as at September 2021 due to advance and performance bank guarantees encashed by 3 customers. We have cash and cash equivalent of approximately 432 crore and a net worth of 438 crore as on September 30th, 2021. We also had a negative working capital of 297 crore as compared to negative working capital of 531 crore as on March 2021. Receivables due for more than 1 year as at September 30, 2021 stood at 412 crores compared to 445 crores due for more than 1 year as at June 30th, 2021. They comprise of related party receivable of 166 crore, which includes receivable of 113 crores against which the company has received unconditional assurance of proceeds from sale of plant. Cash flow. On the cash flow front, during H1 FY 2022, we had a negative operating cash flow from operations due to increase in working capital on account of BG encashment of 404 crore and payment to overdue vendors. Amount received from ICDs and additional borrowing from banks have been used to meet the requirements of cash flow from operations. Upgrade in credit ratings. In October 2021, India Ratings and Research have upgraded Sterling Wilson Solar Limited's long-term issuer rating to IND AA- from IND BBB+, while revising the rating watch to rating watch positive from rating watch evolving. According to the credit rating agency, the upgrade reflects an improvement in SWSL's financial and liquidity profile at the standalone level, majority on account of an inflow of rupees 741 crores of ICDs from the promoters, which have been used to repay the entire outstanding term debt. The upgrade in rating also reflects an expected improvement in the business and financial profile and a further improvement in the liquidity profile of the company, as there would be a further cash inflow of 1,100 crore subsequent to the acquisition of a 40% stake by Reliance New Energy Solar Limited in SWSL. Additionally, Acuity Ratings and Research have also upgraded the rating for commercial papers of 200 crore to Acuity A2+. With this, we can now open the floor to questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Akash Mehta from Capex Investment. Please go ahead.
Hello. Good morning, sir. Thank you for taking my question and the detailed update on this operations. First question I had was that we had accounted for one-offs in our previous quarter results, and just want to know, why is there a spill-off for the same in this quarter as well, and will it continue in the second half of FY22 as well?
I will take this question. So, if you see, we have explained in our investor presentation that module prices have continued to increase. Module suppliers have continued to increase their prices. We have faced effects of that. Also, freight costs were earlier at between $7,500 to $13,500 per 40-foot container, still continue to go up to $11,500 and $18,400 per 40-foot container. All of these price increases have led to the effect. So while we believe There were one-offs which impacted us in March 2021. The increase continues even now, affecting our performance for this 6 months.
Okay, and when can we expect a complete turnaround in terms of our operation metrics?
See, the prices which are going right now are too volatile for someone to take a complete view on when this turnaround is expected. We will have to wait for this super cycle to come before we are in a position to give a prediction on how things will turn around.
Okay, makes sense. And just last question would be, how does the company plan to basically hedge itself against any future volatility in module commodities and logistic prices? Any color on that?
So the company right now is in various stages of discussions with module suppliers as well as customers to try and reduce the dependencies on various costs. So while for modules, we definitely have a kind of strategy in place, one has to keep in mind that as far as logistics costs or other costs are concerned, it is a part of business risk which has to be adequately costed, which we have been doing from a number of years, except for the commodity super cycle which has existed over the last 9 to 12 months.
Okay. I think that's it from my side. Thanks for that.
Thank you. The next question is from the line of Mohit from DAM Capital. Please go ahead.
Yes, good morning, sir, and congratulations on getting a marquee investors on your as a shareholder, a strategic investor. So my first question is, how does this new investor coming in changes our opportunity basket, and does it change anything in terms of strategy for us for the next couple of years?
Yeah, so as you know, with the new investor coming in, as you must have known, Reliance is committed to making India a global leader in green energy based on the latest and most competitive technologies, and they are capturing the entire value chain of the solar, starting from silicon to modules and storage. So the couple of years down the line, so we'll be able to source that all the products from India, and that will reduce our dependency on the global markets. So that will enhance our portfolio as well as reduce our risk significantly. So this partnership will add a lot of value to our portfolio, our top and bottom lines. And on the other hand, the Reliance is also committed to make India a green energy hub. So they will be adding significant capacities, so which will also add to our business top and bottom lines. So we see that, and our balance sheet will grow stronger year by year. So we see that all the three synergy, adding the financial strength, capturing the entire value chain, and their captive projects which will be coming in India will provide a lot of business to us. So all the three areas put together will give a lot of impetus to the business, and we don't see any change in our strategy going forward. So we'll continue to maintain our global leadership in EPC space going forward as well.
I understand that the H2 is going to be challenging for us. So how do you see FY23 in terms of order opportunity from international and domestic market? Have you seen the clients, floating tenders at least, so that we can close it somewhere in FY23, especially in the solar space? And if you can comment something on the waste energy market, the tendering which you believe is likely to close in FY23.
Yeah, so as we have explained in our investor presentation and opening speech, that though the bids were there this year as well, but the decision making has moved to FY23 due to volatility in the global markets. So projects are not viable. But we see the markets also stabilizing, and all the pent-up demand. We see the market growing at the rate of 10 to 20, 15% every year, plus the decision making which is not happening this year, all the projects getting moved to FY23. So we see a big movement and enhancement in order booking in FY23. We see a very foresee at this point of time, if market stabilizes, a great good growth in our order booking in FY23.
How do you see the Middle East in the H2 or FY23? Is it going to be a key market for us?
So Middle East, we are taking a cautious approach, as we have explained in various investor calls, That because of the Chinese competition in the Middle East market, we are very, very cautious, but we are taking wait and watch approach in Middle East market. But US, Europe, Latin America, they are going to be very, very strong markets, and we see a lot of robust growth in those three markets, and they are our target markets.
And how is Australia, sir, right now?
Yeah, same applies to Australia for FY23 because many of the projects getting decided this year. So we see a regular growth plus a pent-up demand in Australian markets as well.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you. The next question is from the line of Avneet Anand from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. First, I wanted to know this Reliance association, obviously great news, but how does an investor in Sterling take this from the point of view that if modules are being sold from some of the entities in Reliance, how does this profitability in the two entities get adjusted?
This is a little presumptuous at the moment. Obviously, all related party transactions are by law at arm's length. We will be able to take this appropriately once Reliance's module capacities are in place. And as of right now, I would not say dependencies because modules are available till such time as Reliance comes up with its factories. But we'll answer that question appropriately at the right time.
Yeah. Secondly, I think Bahadur sir did mention that even if you adjust for the one-off that we have had, the gross margin in one edge should have been somewhere around 3 to 4%, right? If I'm not wrong, that was the number. So we used to do somewhere around a double-digit number in the last 2-3 years. So what is needed from the company and external environment point of view that we will go back to our double-digit gross margin numbers, say in 23, 24, whatever timeline you think is suitable?
Okay. First of all, the 3% is also because of the carryover effects of the one-offs which we faced in Q4 of FY21. Otherwise, we would have been close to what we normally do. At the same time, what we are seeing is bids right now, the global bids have again gone up by almost 20 to 30% due to increase in prices. And these projects will come up for bidding next year. So if all of this stabilizes, if the external environment stabilizes, I see no reason why we cannot go back to what our normal margins were in the earlier years. But as of right now, these have been affected, as we have repeatedly said, due to the ongoing external issues not entirely within the control of the company. This is something that has affected various industries and most notably the solar industry and not just Sterling Wilson Solar.
Yeah. I appreciate that. Thirdly, and this is last question. See, domestically, if we go 1-2 years back, domestically probably we were 20% odd, plus minus 5% in terms of our order book. And maybe it used to be around 2,000 crores. If you see in the last 2-3 years, I see, I don't want to mention name, but Tata Power, for example, does EPC solely in India, has an order book almost of 8,000 to 9,000 crores. So what exactly have we missed in the domestic market, which itself is a decent market as of today, where we were almost number one, and now probably we have slipped a lot. Thanks.
No, we have not slipped a lot. We are still in the top two as far as the domestic market is concerned. Of course, with Reliance coming in, that will certainly help us drastically in the domestic business for sure. We continue to remain in a leading position in the domestic market. Even right now, we have won orders in this year in the domestic market from 2 premium customers. We do not believe that we have slipped so much right now, and we will continue to maintain one of our leading positions in the market. And of course, let's keep one thing in mind, that when we are talking of our turnover, we do not have modules in domestic business. It is always X modules. while Tata Power includes modules in its overall scheme of things. So that also brings into account almost a 40% differentiator in terms of turnover. Selective in choosing. We are also very highly selective in choosing of our customers. Not to say they must not be, but we prefer to be cautious.
And do we do public sector orders? Because I don't see they have a lot of public sector orders in India from the types of, let's say, NTPC and some SJVN and others. So do we participate in tenders for them as well in EPC?
Yes, we do, unless the tender includes sourcing of land, because there is too much of risk if land sourcing is also involved, especially in India. So we do not do any orders with land.
So is it fair to assume if 10 gigawatt ordering happens in India, how much of that would include orders with sourcing and orders without sourcing of land? The ballpark number will
we do not do any orders with land. None.
And sir, is that if India is a 10 to 15 gigawatt market now and it will grow, what percentage of that would be with sourcing of land and what percentage without sourcing of land?
We'll have to check and come back to you on this, Abhinay.
Sure, no issue, sir. Thanks a lot. Thanks. Those were my questions.
Yeah.
Thank you. The next question is from the line of Samir Palod from AEM Fund Advisors. Please go ahead.
Yes, hi. Thank you for the opportunity. So just if you can walk us through when on your order book solar module prices started going up and the logistic costs going up, what would be the behavior of your customers, your IPP? What sort of discussions have you had with them for letting some pass-throughs, etc.? So just want to understand the structure of the industry when this unprecedented volatility comes into being in your business.
So when this unprecedented volatility in module and logistics started coming in, we have initiated discussions with most of our customers where we are getting impacted, and discussions are in advanced stage, and some of our customers have given some compensation to us also, and discussions are in advanced stage with other customers. And as a part, the module and the commodity risk is on us. But going forward, we are building some strategies to pass on to the risk the customers and protect from the increase with our module suppliers as well. So that is an ongoing process and that is in place.
But sir, the module suppliers from China obviously have not agreed to stick to their commitment. So how are you going to enforce anything against Chinese module suppliers? Is it going to via bank guarantees or?
Yes, so that's one of the strategies, to have the higher amount of bank guarantees from the module suppliers in China, as well as we are taking a part of our bidding strategies. So how to protect the maximum risk at the bidding stage, and so that the risk can be passed on to the customers going forward.
But isn't the customer an IPP who's bid a particular power price and hence is very sensitive to any increases in the cost of the project?
Yeah, that's why this year all the projects are getting pushed out to next year. They are sensitive, but they are also working on strategies and building in tariffs. As you would see that this year tariffs, most of the tariffs which the biddings are happening, the tariffs have gone up by 10 to 20%. So everybody is taking those factors into account and building suitable strategies to handle this price increase and to protect against the volatility in the market.
Okay, and my second question is for your unexecuted order value, how much more gross margin damage are you going to see, or is that whatever is current prices have already been baked into the provisions you've taken, or are we going to see extended gross margin level losses for the next 2 quarters as this order book gets executed?
So I'll break up this into 2 parts. First of all, what is the module exposure that we have in the unexecuted order value? As of right now, the pending partial supply of modules are only for 2 projects, which is 420 odd megawatt, aggregating to about 750 crores. For this, the orders are finalized. The LCs have already been opened on the vendor. Now, if there is no further reneging, this is the kind of quantum that we have already factored in as part of our costs. As of right now, we have taken all costs which we believe are required for completion of the project. But we are in circumstances where prices are not fully within industrial control. Things are fluctuating. So we expect that gross margins of H2 will also remain suppressed. As I have mentioned, we have taken all the costs already in place, unless there are further increases which come in, which are beyond calculation at the moment.
But sir, if everything's already been taken at current prices, then why will gross margin not trend in the next 2 quarters itself trend back to high single digit or even your earlier 10% odd levels? I mean, I understand if prices remain further volatile or go up further, but if those prices remain constant, why should you not be able to maintain gross margins over the next 2 quarters? Is there anything that I'm missing?
No, you're not. So we will have the gross margin, but if you're looking at it from an annual basis, it will be a suppressed overall picture. As of right now, we are definitely seeing gross margin being higher in H2 as compared to H1, unless there is a module, logistics or commodity impact which comes and hits us. So all things remaining constant, your understanding is absolutely right.
So would it be fair to say that this unprecedented volatility in logistics and module prices have sort of overall changed the way the whole solar EPC contracting business is going to renegotiate its contracts, both at the IPP end and at the vendor end?
As I mentioned a little while ago, while we do have strategies which we are implementing for modules, one has to keep in mind that things like commodity, freight, etc. are part and parcel of business risk. And therefore, that is not something that can be completely passed on. Of course, buffers can be built into cost, which we do even now, but those buffers have been breached. If you would see our investor presentation on slide number 7, it clearly shows how last year the freight costs were about 1,800 to 2,000 crores per 40-foot container. They are at $18,000 and $11,000 per 40-foot container now. These are phenomenal price hits which no one can take. But again, answering your question, in the next 2 quarters rather, if everything remains a constant, for that quarter, the gross margin would be up. But on an overall year basis, it would definitely be suppressed.
Okay, thank you for that. All the best.
Thank you. The next question is from the line of Vipul Lamba from Lamba Investments. Please go ahead.
Hi, thanks for taking my question. What is the base commodity for module prices? Because the price increase which has happened is significant. And which is other than the base commodity, is there anything else in power, demand supply gap or anything else which is leading to such kind of increase? And what do you see as a future trend coming up?
So the base commodity for modules is the polysilicon, the price of which have shot more than 4 times over last 1 quarter. So as you know, the major production of polysilicon is happening in China and prices have got significantly impacted. And some of the facilities in China has come under scrutiny from various countries because of the social issues, and that has also impacted the polysilicon prices. As far as the module production in polysilicon, what was the factor which has severely impacted over last 1 month is the power rationing and rationalization in China. So most of the manufacturing, not only polysilicon and module manufacturing facilities, the other facilities are operating almost half their capacity. So which has created a supply-demand gap, as well as the price increase due to increased overheads and production costs by the manufacturers in China. So this has led to a sharp jump over last 4 weeks itself. So we have seen significant increase there. So that's the immediate reason for the increase in module prices.
And in terms of future trend, as the solar industry is dependent on this, what do you see? Because these kind of challenges you're talking about, considering the China economy, they may go on for some time. The unrest which is there or the slowdown which is there in China right now, this may continue. So how do you see it as the impact on the overall industry, including your business, even if you start passing on the cost of such increase or risk yourself from the module price risk? But how do you see the overall industry moving?
Overall industry, I think with the industry has realized that we have to have all the countries and globally there is a movement that they are delinking from China and local capacities are coming up. And as we have said, in India also the huge capacities will come up in next 18 to 24 months. So as we see these, the short term it will continue to be challenging, but in the long run we'll be delinking ourselves from the global dependencies will reduce and we are able to reduce products from Indian market, and that will provide a significant risk reduction in our operations.
Okay. And what do you see this Reliance deal getting completed? And is there a possibility of, because they are buying 40%, how would be the promoter share look like after that of shareholding?
So I'll take that. It is broken up into 3 tranches. The first tranche is where there will be an infusion of about 1,100 crores into the company. That would give them close to 15% of the enhanced share capital base. Post that, there will be a first tranche of about 10% of the enhanced base, which they would buy from the promoters, taking them to 25%, triggering an open offer. In the open offer, they would want to come to about 15% more, thereby taking it at 40%. If the open offer, if they receive more, they would sell down. They and the promoters would sell down such that on an overall basis, finally, Reliance would be at 40%. The existing promoters would be around 35%, and the public shareholding will be about 25-26%. This is the overall understanding that is there on how the deal will transpose.
Okay. And from a future strategy perspective, in terms of the business, it is that we are trying the best possible to de-risk from the commodity price and be a more of a service play rather than the product play business, and that's right.
No. So we will always be supplying products as part of our overall offering, except in markets where modules are not part of our scope for the moment, example India. But everywhere else, we give balance of supply, or BOS as we call it, for the entire EPC offering.
Okay. So just last question. How much is maybe I've missed it, how much is the backlog left where we have the old pricing and the cost implication is that we have to keep booking considering the change in the market prices?
No, all our orders, as Mr. Amit has explained, are lump sum orders with a fixed price. We are in discussion with customers for asking for enhancement of costs. That's an ongoing discussion that happens. But all of our customer contracts are lump sum fixed price.
No, how much is the order book is such left which has this kind of risk of commodity pricing impacting our business? How much is the value of the order book which is still to be booked in?
So in terms of modules, as I explained, it is about 100 million in this entire 6,730 crores. And roughly about 4,000 odd crores is the solar order value, where the risk is there. We have factored in all the pricing, but these are the final lump sum prices which are there.
Okay, thank you. Thanks for taking my question.
Thank you. The next question is from the line of Anuj Jain from Globe Capital. Please go ahead.
Yeah, good morning, everyone. Thanks for taking my question. Sir, I just want to have one basic, I'm just having one basic question. Like the orders on which we are taking the hit, right? Our cycle is generally of 12 to 15 months. So I am assuming those projects which are there in the month of September, probably they might have initiated in the month of September 2020. And as per our cost escalation in terms of module prices and logistics, we have seen the cost overrun in the last 1 year. So just want to understand, while initiating contracts in the last, after June 2020, didn't we take that thing into account with the customers that costs are going, haywire? So why didn't we take that kind of floating kind of thing into our contract? Otherwise, it is a big problem. And as per our last con call after March quarter as well as after the June quarter, as per your commentary, you said that you are almost, I don't exactly remember what is the bifurcation of the short-term contracts and the long-term contracts. And you were saying, yes, there is a possibility of cost overrun in the short-term contracts, which are not of much magnitude vis-a-vis the long-term contracts. So I'm not able to understand the kind of cost overrun which we are currently going on. I mean, without passing on to any of the customers. I mean, it's little surprising. So can you please elaborate on those fronts, sir?
Okay, Anuj, I will draw your attention to slide number 8 of our investor presentation, which I will just speak about. You will see that we have booked orders of about 2,000 crores, out of which 1,500 is the waste to energy. So the orders of pertaining to solar, which is there in this entire UOV, which is booked in the current financial year, is just about 500 crores. At the same time, you will also see that price variations of almost 200 crores, 183 to be precise, have been approved by various customers. So whilst we have mentioned that we do not take risk of modules in long-term projects, but there are other prices also which have gone up, not just relating only to modules. Commodities have gone up, freight have gone up, and all of this continues to impact the entire UOV. So it has nothing to do with short-term or long-term except for the fact about module risk. Module risk we already explained today. The balance modules which have to be shipped are just about $100 million or 750 to 760 crores in the entire UOV that we have as of now. Have I addressed your question, Anuj?
Yes, sir. Thank you, sir. That's it from my side.
Thank you.
Thank you. The next question is from the line of Vetri Raju from Equity Analysts. Please go ahead. Mr. Raju, your line is in talk mode. Kindly go ahead with your question, please. As there is no response from the current participant, we move to the next question from the line of Manoj Dua from Geometric. Please go ahead.
Sir, congratulations, sir, with your journey with Reliance. And I understand this commodity super cycle has been once in a lifetime thing which we have seen. And I appreciate that management has to work so hard to counter all these things. So my question is, when you suffer that kind of loss or kind of headwind we faced, which may not repeat, and maybe try to create lot of hedges to protect that in future, which may be too much providing for risk, and in being our low margin business, do you think it's right to think too much for the risk in the future in terms of this super commodity cycle? Thank you.
See, all business is fraught with risk. There is no risk, there is no reward. So one has to take in a balanced view of how much of risk one needs to factor in. Obviously, there are some items like modules which we cannot live with because those would impact the business significantly. But a lot of the other line items of risk, we are internally also evaluating to see how much of these we can live with, because at the end of the day, business has to continue. And you have to also keep in mind that in spite of all of this, players with strong balance sheet and track record like ourselves have managed to hold our fort and will continue to go forward and reap the benefits.
Yeah, really appreciate that. This is what I was trying to think, that we may not unnecessarily create too many edges and reduce the margin. My second question is, can you explain me how this second tranche of shifting of shares to Reliance will happen? Will it be off market or on market? Can you provide some details to it? And if the Reliance doesn't get the shares and the open offer, then again you have to shift it to off market or on market. Thank you. It's my last question.
No problem. So the off market, on market will depend on the price which is prevailing on that day. So I cannot right now offer a comment on how whether it would be off or on market. As I have already explained, after Reliance reaches 25% and does the open offer, depends on the success or not of the open offer, but Reliance wants to achieve about 40%. and it will then take them either from the existing promoters if there is a shortfall in the open offer, or entirely from the existing promoters if there is no success in the open offer.
Can I ask one more question?
Please go ahead.
Okay. I'm not worried about the related party transaction which may happen in future because that is by law. There are provisions for that. As a shareholder, old shareholder of Sterling, I'm a little bit worried about if any case the merger would happen with Reliance because we invested for something of ESG for a longer term and that would fail our purpose to being invested in a Reliance industry as a collective group. Is there any provision made that any merger won't happen?
There is nothing that has been discussed on this front at the moment. And Reliance itself, in its open offer and public disclosures, has said that it only wants to have 40% in the company. And it is also held through Reliance New Energy Solar and not through Reliance Industries.
Okay. Thank you. So nice and best of luck.
Thank you so much.
Thank you. The next question is from the line of Mohit from DAM Capital. Please go ahead.
Yes, sir. Thanks for the opportunity once again, sir. So my first question is on what is the usage of proceeds from the Reliance money?
It will be utilized for working capital requirements of the company. And the rest, if as whatever surplus may be there, would be parked for future utilizations, expansions, or strengthening of the balance sheet to bid for bigger projects.
And when is this money expected to come?
So there are certain approvals that are required for these transactions. Some of them have already come in. Some of them are expected shortly. If you see in the presentation, we have mentioned which approvals are pending. Right now, what is pending is the CCI approval, which is one of the primary requirements for the first tranche or the primary issue. Once that comes in, we would be able to fructify the first transaction.
Okay. And sir, as far as bank guarantee encashment is concerned, do you think, in your mind, in your opinion, what is the chances of reversal of this, bank guarantee?
See, first of all, we have quite clearly mentioned it in our note as well as explained it to our auditors that we believe that we should be able to get our money back from the bank guarantee very shortly in this quarter, and we would be in a position to give you a complete answer by the time we come about giving the investor call for Q3. This is on account of certain misunderstandings between two customers. There were operational disputes. There were claims and counterclaims, so the customers have encashed the bank guarantees. We are in advanced talk with the senior-most management, and we believe that this thing will reverse very shortly.
Understood, sir. Thank you, and all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Danish Mistry from Investor First Advisors. Please go ahead.
Hello, good morning, and thank you for taking the time out, and congratulations on bringing on a marquee investor. You mentioned basically that the solar panels are about solar modules are roughly about $100 million in your kitty that is left. Is this at current market prices, or is this at the book value at which the order was booked? Thank you.
No, they are at current market prices on the basis of the latest contract amendments that have been signed with the module suppliers. So all the latest prices that we are aware of and signed off till date have been considered. Of course, if something goes off there and then there is a further increase, then that is a completely different ballgame. But as of right now, that the latest amendment is what we have signed. If you see the amendments right now between 23.5 cents, present market trends are 27 to 28 cents.
Right. Got it. And just one more thing. So when we start supplying these modules, let's say for example the Chinese don't renege on us, and if we start supplying, then are these is the increase already booked in our P&L, or as and when we supply, the increase would get booked and accordingly margins get impacted?
No, the gross margin which is shown today is after considering the increased costs of modules which have been signed.
Mm-hmm.
Right? So just because you supply it doesn't mean that the loss comes in then. That's already factored in, as long as it is at the present signed contracted price.
Got it. And just last question from my end. This 1,100 crores that will come in from RIL whenever it does, and even the ICDs that came in actually.
New energy solar and not RIL, huh?
Sorry, yeah. Okay, I'm sorry. Okay, but so let's say, for example, the funds that we got from the ICD, forget the fresh infusion. Would that make us net debt free once we recover the bank guarantees from the customers?
Well, if the bank guarantee were not there, we would be, you can very clearly see that we would be net debt neutral.
Right.
But, of course, with the Reliance money coming in, subject to whatever is required for working capital, the banks will all go towards making the company as net debt free as possible.
Understood. Great. Thank you so much, and wish you the very best of luck. Thank you.
Thank you.
Thank you. The next question is from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Yeah. So, am I audible, sir?
Very much.
Sorry to interrupt. Your voice is breaking up.
Can you hear me now?
Yes. Please go ahead.
If the entire pie of solar EPC is to be taken in the developed countries at least, what part of the solar conversion from thermal energy has happened? And how much remains? So I just want to know what is the kind of work which can be had for the next 20 years or so. And second is that this waste to energy project that we have got, which is worth around 15 crores. Now this is a very big area, and most of it is being catered by Japanese majors who are having the technology and the wherewithal to actually execute these kind of projects. So where do we see ourselves in this space, and can we get some more orders on that, and how profitable it is? Is it less commoditized than our solar modules EPC business?
First, taking on your waste to energy part, as you rightly said, it's a huge market, and we are targeting UK and Europe for this business. And every year, we expected this market to grow in that market by $5.25 billion annually, and we have a good pipeline there. So, and the space we are operating in, you are absolutely right that this is a niche market, and we expect that business to grow significantly. And the margin in that particular segment remain between 10 to 15%. So that's where waste to energy market is there, and there is literally a huge potential in that market. And thermal to solar is, as you know, that financing is becoming a constraint for thermal plants going forward. So year on year, that they are adding significant portion to the solar pie. And I see like roughly 15 to 20% of the market is getting added to solar by closure and non-capacity addition of thermal plants.
There would be only 4 players in waste to energy at this point of time?
It's difficult to say, but it is definitely a niche market. There are some players. We also have the technical expertise within the group, which enables us to go ahead and become one of the leading players in the waste to energy market. Right now, as Mr. Amit has explained, our focus is majorly UK and Europe.
Solar EPC itself would be definitely good 20 years business to be had.
So even I would say, yeah, that definitely it's a business going forward because new technologies will keep coming in. And our other portfolio of battery energy storage and green hydrogen will be another area which will further lead to the further increase in our business portfolio for solar energy. So definitely we saw this business going strongly for more than the next decade and even up to 20 years.
Thank you so much, sir. And I really hope that in the future Reliance is able to really have a lot of synergies with you, with our top management, and we continue to have these phone calls. Thank you, sir.
Thank you. Thank you.
Thank you. The next question is from the line of Vetri Raju from Equity Analysts. Please go ahead.
Hello, can you hear me?
Yes.
Okay, thanks. I know most of my whatever I wanted to ask has been answered. I just have one question. With the customers getting very cautious and trying to delay the projects, and maybe we as a company also very cautious, in terms of not losing money. Is it fair to assume that FY22 revenues will be potentially lower than FY21 revenues?
No, not really. Considering the order book that we already have in hand and the execution that we are planning for that, we believe that FY22 revenues will be at least 10 to 15% higher than what we had for FY21.
Oh, thank you very much. And just the previous question, I got the answer that green hydrogen is also a potential, diversification of the company, because largely the source of electricity is from solar or wind or something. So, is there any concrete plans to get the engineering talent in that area, or it's a few years away?
Yeah, so no, we are right now focusing on the renewable energy, which is associated with green hydrogen. So we are focusing on that part right of now. So, and the plans will evolve in future. But as of now, that's it. Like, I think strategy making is in progress. So we can't comment anything concrete on that part as of now.
Okay, fine. Thank you.
Thank you. As there are no further questions, I now hand the conference over to Mr. Amit Jain for closing comments. Over to you, sir.
Yeah. Thank you. With the robust backing of Reliance Group and Shapoorji Pallonji Group, we endeavor to accelerate our growth trajectory by blending our robust project execution capabilities with the manufacturing size and scale of Reliance Group. We plan to grow significantly in the large markets in the US and Europe, where we foresee a huge potential of growth. India too has reached an inflection point from where we anticipate the growth of solar power industry to garner further pace and momentum. With our deep-rooted client relationship, global presence, ability to provide customized solution, strong track record of executing complex and large-scale projects supported by a robust balance sheet, and strong parentage of Reliance Group and Shapoorji Pallonji Group, we are confident of navigating current tough times and emerge much stronger. I would like to thank everybody for joining the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with Vishal Jain or Strategic Growth Advisors, our investor relationship advisors. Thank you once again and have a great day.
Thank you. Ladies and gentlemen, on behalf of Sterling and Wilson Solar Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.